friends, as you know, the prime objective of this channel has been to educate and suggest very minimal or almost zero risk option strategies which will result in enhancing your stock returns in the range of 6 to 12% per annum. Subsequently, in addition to this, I also planned to recommend the stocks which I believe were able to deliver minimum 12% return per annum using techno funda analysis. I have decided to do this whenever an opportunity exists in the market. My first and only recommendation is Z Entertainment. The stock was recommended in the last week of August when it was trading at 170 level. I recommended it once again in my video posted on a day before yesterday, that is on 12th September, when it was trading at 180 level. You can watch it and you will find it almost at the end of the video. Even the video which I posted yesterday ended up with the price information of Z Entertainment. Friends, I am very happy to inform you that today it is the best performing stock of the day. In first half an hour, it was up by 20%. It closed at around rupees 261. And this recommendation has given around 54% return in 15 days and around 40% in 1 day. Hence, our first and the only recommendation under this category is far ahead of our minimum threshold of 12% per annum. But as you know friends, minimal risk option strategies will remain our area of focus. In the yesterday's video, I mentioned that we would not keep stop loss. Instead, we would square off the positions once the market substantially goes up and goes down, and that too at more than minimum profit. I had mentioned the reason in brief, but as I promised, I am going to share how it works in today's video. Among all three positions which we had executed yesterday, we will go ahead with the most critical one. And if it works in the case of the most critical one, it ensures that it has to work in other cases too. The most critical positions among them is short ratio call spread of 40,000 and 40,800 call in the ratio of 1:2, as the difference between the two strike prices is least. Let us assume today is 13th September, and if it works on 13th September, it will have to work on remaining days. Let us do a simple math using option pricing calculator. As you know, the determinants of option pricing are: first, strike price; second, spot price; third, time; fourth, volatility; and fifth, IR. We will insert the data and will try to be as conservative as possible. So we have to take underlying price as 40,000 and strike price as 40,000, and point in time we are going to take as 13 and expiry date on 16th. And volatility, this it's 26%. It is based on the historical data. The interest rate, we want it to be conservative, so we will take 91 days treasury bill, which is 3.3%. Let us take volatility interval as 5 and price interval as 100. Let us calculate it. And friends, as you can see, the expected option price turns out to be 381.538. Let us call it as 382. And for next, the underlying price is going to be the same, 40,000, and the strike price is going to change. It is going to be 40,800. And point in time same, expiry same. And friends, the volatility, we are going to increase the volatility to 30%. Because we want to be as conservative as possible. And the interest rate, it is also going to change. Interest rate will take it as 10 years government bond yield, which is 6.2, because here also we want to be as conservative as possible. 6.2. And the volatility interval the same, and the price interval is also going to be the same. Let us calculate it. And we have got the option price as 154.46. Let us assume it as 155. And then 155 multiplied by 2, which is 310. So we are left with 72 rupees in our pocket. And this 72 rupees is the profit per unit. So the total profit turns out to be 72 into 125, which is 9,000. Which is more than our minimum profit. So our minimum profit is 518.75. If you have not understood, let me explain you it in the simplest form. So these are the screenshots of 13th September, and Bank Nifty was 36,471.80. As you know, we want to see what happens to our strategy if market goes up to 40,000 level on 13th September itself. And 40,800 call is 2% higher than 40,000. So we will imitate the situation. Hence, 13th September Bank Nifty price, which is 36,471.80. We will treat it as 40,000. Second strike price of 40,800 is 2% higher than 40,000. So we will add 2% in 36,471.80. So 36,471.80 into 1.02, which is 37,201.236. So let us assume it as 37,200. So now let us see the premium of 36,500. It is 238. So 238. And let us see the premium of 37,200. It is 34.45. Now we will have to multiply it by 2. So 34.45 into 2, which is 68.9. So equal to 238 minus 68.9. It is 169.1. It is per unit. This is a profit in our pocket, but it's not the total profit. The total profit turns out to be 169.1 into 125. So the total profit turns out to be 21,137.5, and it is more than our minimum profit. Our minimum profit is 580.75. Thank you and have a good day, everyone.